Adjustments to accounting income for determining taxable income. When calculating the taxable income for corporate tax purposes, a taxable person must consider several adjustments to their accounting income. The aim of these adjustments is to ensure that the taxable income accurately reflects the income that is subject to tax, excluding any income or deductions that are exempt or not relevant to the tax computation. Below is a detailed explanation of the key adjustments that must be made when calculating taxable income, along with other specific cases that may require additional adjustments. 1. Unrealized gains or losses. An important adjustment to consider is the unrealized gains or losses in a taxable person's accounting records. Unrealized gains and losses arise from changes in the value of assets or liabilities that have not yet been realized through a sale or transaction. For example, if a company holds investments that have increased in value but has not sold those investments, the gain is considered unrealized. For tax purposes, only realized gains or losses should be included in taxable income. Unrealized gains and losses must therefore be excluded from the calculation of taxable income, as they do not yet reflect actual economic benefits or costs. 2. Exempt income. Certain types of income are exempt from corporate tax under the law. For instance, income earned by exempt persons such as government entities, qualifying public benefit entities, or income from specific transactions like certain investments may not be subject to tax. Taxable persons must adjust their accounting income by excluding any exempt income to ensure that only income that is subject to tax is included in the taxable income. This includes income such as income from investments in qualifying investment funds, income received by qualifying public benefit entities that meet the necessary conditions for exemption, income derived from specific activities that are exempt under UAE corporate tax law. Excluding exempt income is a necessary step to ensure that the taxable income is correctly determined and does not overstate the amount subject to tax. 3. Deductions. Taxable persons are allowed to make certain deductions from their accounting income. Deductions can include business expenses that are incurred as part of normal operations, such as operating expenses, including salaries, rent, utilities, and materials, depreciation of assets used in the business, interest payments on loans that are directly related to the business. These deductions reduce the overall taxable income of the taxable person, thereby lowering their tax liability. It's important to ensure that only allowable deductions, as specified under corporate tax law, are taken into account, and that proper documentation is maintained to support these claims. 4. Reliefs for specific transaction types. In some cases, taxable persons may be eligible for tax reliefs related to specific types of transactions. For example, businesses may receive reliefs for research and development, R&D, activities, capital gains arising from the disposal of certain types of assets or shares, business restructuring or merger activities that meet the necessary criteria under the corporate tax law. These reliefs are designed to incentivize specific business behaviors and may be applicable depending on the nature of the transactions and the business activities conducted. It's essential to review the relevant provisions of the law to ensure that any reliefs are properly applied. 5. Transfer pricing adjustments for related parties or connected persons. Taxable persons must also consider transfer pricing adjustments when engaging in transactions with related parties or connected persons. The UAE follows an arm's length principle in transfer pricing, which means that transactions between related parties must be priced in the same way they would be if the parties were unrelated. If a taxable person engages in transactions with a related party or connected person and the pricing of these transactions is not consistent with the arm's length principle, adjustments must be made to the accounting income to reflect the appropriate pricing for tax purposes. This ensures that profits are not artificially shifted between related parties to reduce tax liability. Transfer pricing adjustments are particularly important for multinational enterprises that have subsidiaries or affiliates in different jurisdictions, as they must comply with both local and international transfer pricing regulations. 6. Tax losses. In certain cases, a taxable person may incur tax losses where their allowable deductions and exempt income exceed their taxable income. These tax losses can often be carried forward to offset future taxable income, thus reducing future tax liability. Taxable persons must keep track of their tax losses and apply any carry-forward provisions as per the tax laws. Losses incurred in one year can be carried forward and used to reduce the tax liability in future years, subject to certain limitations. The proper treatment of tax losses is an essential part of tax planning and compliance. 7. Additional adjustments for specific cases. In addition to the common adjustments listed above, there are several specific cases that may require further adjustments to a taxable person's taxable income. These adjustments are typically relevant in situations where there are unique structures or business activities involved. Below are some examples of specific cases where additional adjustments may be necessary. A. Transfers within a qualifying group. In the case of a qualifying group, certain intra-group transactions may require adjustments to prevent tax avoidance through the shifting of income or deductions between group entities. The tax treatment of these transfers will depend on the group's specific tax structure and the provisions of the corporate tax law, and adjustments may be required to ensure the correct taxable income is reported. B. Business restructuring relief. If a taxable person is involved in business restructuring, they may be eligible for tax relief that affects their taxable income. For example, in cases of mergers, acquisitions, or other restructuring activities, special tax provisions may apply that reduce or defer the recognition of taxable income or gains. These reliefs are designed to facilitate business restructuring and prevent tax barriers to such activities. C. Partners in unincorporated partnerships. For unincorporated partnerships, the individual partners may be subject to different tax treatments depending on the structure of the partnership and their share of the income. In this case, adjustments to the partnership's accounting income may be necessary to allocate income and expenses correctly among the partners, ensuring each partner's taxable income is accurately determined.